All right, the real estate and mortgage rate update for February 18th. You can see here 30-year fixed national average 6.05%, 15-year fixed 5.62%. This is the national average. Now, I did include the principal and interest payment as I've done before. This is for a 20% down on a median home price in Clackamas County, which is 602,560 approximately. And so that gives you a loan amount of 482, and that would be your principal and interest payment currently. Now for the next part of this, I want to bring in this graph. I'm going to talk about this in detail. But essentially, if we go back all the way to 1970 to current, the average mortgage rate is 7.7%. And so there are only a brief period of sustained time that mortgage rates were 5 or under. And I want to go through the data on that and just touch on that briefly. Hey there, everybody. A lot of people I speak with say they're waiting for 5% or less mortgages. The data, though, reveals that that only happened during financial crisis and pandemic level intervention. If you're waiting for disaster to buy a house, that's a hope. It's not a strategy. But if you're looking for opportunity, this market may actually be it. But I want to double down on the data just so we can all kind of understand what this all means. The only sustained multi-year period where mortgage rates were below 5% was from 2010 to 2022. The average mortgage rate from 1970 to today has been 7.7%. From 2009 to 2022, which is really the only sustained period of those low rates, the Fed purchased trillions of dollars in mortgage-backed securities, which directly suppressed mortgage spreads, and it was historically unprecedented. So when we talk about like the Fed spending here, we have to bring in deficit spending. So deficit spending, which has really ramped up in the last 10 years, this really makes sustained low rates much less likely without recession or that Fed intervention of buying mortgage-backed securities. When we take a look at these sub 5% environments and what occurred during those times, this was post 2008 financial crisis. This was also the COVID shutdown or emergency monetary policy that we all saw in that kind of March, April, May timeframe of 2020, and heavy Fed mortgage-backed security buying. So what would actually push rates below 5% again? It's only going to be likely if severe recession, major financial crisis, or a massive Fed quantitative easing would begin again. So in other words, and not what a lot of the media will say, not because inflation is cooling, not because the Fed cut 50 basis points or half a point, and not because of different changes in the administration. Now, will those things all affect rates? Yes. But I think that we're very unlikely to see sub 5% unless we were to see some of these real radical things, particularly like a pretty solid recession. And it just doesn't appear as though economically that we're heading that direction. So right now, the perfect storm exists because we've seen price softening. We've seen sellers that are far more likely to work with buyers on helping with closing costs, helping with buy downs, negotiate. And I just think it's a really, really great time right now. We're seeing a lot of inventory come back on the market. So, if you're a realtor, this is what you should be messaging to your clients. And if you're looking to buy in 2026, really if any of this were to happen in the market, the financial markets, we're always going to have an opportunity to improve down the road, improve your rate. What you can't refinance is the price of the home, and we're going to continue to see those move upward just because we continue to have a shortage of homes overall. So hope that helps. If you have any questions, feel free to reach out anytime. Thanks so much.